But it's now for more here in the studio. Mark Canizares, the head of Equities of Manulife Investment Management and Trust Corporation, which manages over 185 billion pesos. So good to see you again, Mark,
Hi.
and
Hi, good
welcome
morning.
to the program. So I was just talking about gold there. So it's it time to buy gold? I mean, it looks like the real deal.
Well, I think the price run-up in gold also reflects the volatility that investors are afraid of or are expecting for the remainder of the year. So the run-up was expected. But as you can see, I think you're talking about the Fed maintaining rates today, and some central banks have also opted to keep rates steady. And I think that's a welcome development to markets. So right now, what we're happy with is that there's some stability in the market. At least there's a pause. There's something that we can look forward to. But I think in terms of rate policy settings, we are still expecting that it will still be about 2 cuts for the year. It might just move forward a little bit.
You know, it's quite amazing that the Fed hold actually gave the markets a little bit of a support, because when the Banco Central kept rates steady, the markets went down.
Correct.
It didn't like what it didn't do. How do you think the Fed communicated what it should, and how do you think that will be taken by the markets here, especially the Banco Central when it meets on April 10th?
Well, I think it was different. So when the Banco Central did not cut as expected, that was the surprise. But remember, when the Fed came in last night, it was already a few weeks into the tariff changes that we've seen in the US, right? So there were a bit of uncertainties that maybe the Fed was also trying to be more tentative, waiting for what will happen, and they also downgraded growth expectations for the US, and we're expecting that inflation would be higher for the remainder of the year, again, because of what the tariffs might do. But for the Philippines, it's a little bit different. Inflation for February, I think, was at 2.1%. And remember, we were actually moving ahead of the Fed in August. Before the first rate cut by the Fed, we moved ahead. And people at that time were concerned, should we cut ahead, should we cut after? But it seems there's space for the BSP to either wait or be ahead by a few months. Remember, monetary policy has also a few months lag. So that should give the BSP a bit of space in terms of how their policy setting meetings will be in April.
Yeah, the running joke was, is it the Banco Central moving ahead and the Fed moving in lockstep
Correct.
with the Banco Central? But there's going to be an inflation report on April 5th. How critical will that be? Apart from the fact that the Fed already communicated what it should, held on steady, inflation expectations are higher, probably growth slower. How do you think the central bank will decide?
I think the expectations for local policy rates is for at least about 25 to 50 basis points. As I've said earlier, it's moving a bit after that surprise no cut in the early part of the year. But the macro numbers, I think, are supportive of what the BSP will be doing. We would not be surprised if they cut or if they maintain rates. There will be a little bit of room on that side. On the inflation front, if you're going to the market or the supermarkets, rice was an issue last year. But when we've done our checks, you can see falls of as much as 10-15% versus the beginning of the year. So that would have an impact because food is about 10% of our inflation basket. But energy prices are expected to also go up because it's the summer months. So that should provide an offset. So in terms of where your basket will be, the inflation print might actually be more manageable, be trending more lower for the remainder of the next few months at least.
Okay, we got about a minute. Where then do we deploy our money? We've talked about gold, pretty speculative down there. Are we going to go for the defensive plays, interest rate sensitives? Whereabouts with corporate earnings out?
So far is that defensives are actually in vogue for the first half of the year at least. You've seen banks move higher in terms of their share prices. Utilities are also there. Telcos are also there. So there's a little bit of defensive that's built into portfolios right now, mainly because of the uncertainty. But going towards the second half of the year, you're seeing a lot of these beneficiaries of lower rates, lower inflation print, higher incomes come into play again. So maybe the second half of the year might be the time to revisit consumer staples, consumer discretionary names that might benefit actually when all of these come down. And remember, we have midterm elections that's also expected to boost consumer spending, at least for the second half of the year.
Looks like you're going to be busy rejigging that portfolio towards the second half of this year. Thank you so much, Mark. Really appreciate the time. Mark Canizares joining us from Manulife Investment Management and Trust Corporation.